Good morning. I'm Jen Amos at Weiss Research.
I'm Andy Myers, and this is your morning market update for Monday, August 8th. We're seeing heavy losses on Wall Street and around the world. Global investors continue to sell out of equities following Standard & Poor's downgrade of U.S. government debt. Economic concerns were already rattling the markets last week. The Dow Industrials fell 5.8%, their biggest decline since March of 2009. And the Nasdaq and S&P 500 suffered even larger percentage losses, marking their worst weekly performances since 2008. This morning, all three indexes are dropping by about 2%, following similar declines in the major Asian and European markets. The sell-off is not a surprise to anyone after Standard & Poor's cut its AAA credit rating on the United States to AA+, the first downgrade ever on U.S. debt by S&P. In addition, S&P lowered its outlook, threatening another reduction in 2 years. The rating agency said the deal reached by lawmakers to cut the federal deficit by more than $2 trillion over a decade didn't go far enough, and, quote, America's governance and policymaking is becoming less stable, less effective, and less predictable than we previously believed.
In addition to equities, the downgrade is also having a dramatic impact on the other markets, especially commodities. Assets viewed as risky, such as oil, are taking a beating. Right now, light sweet crude is tumbling more than 4% and is trading just above $83 a barrel. But on the other side of the spectrum are precious metals, which are considered safe haven investments in times of uncertainty. Gold is jumping by $50 an ounce, crossing the $1,700 mark for the first time ever. And silver is closing in on $40 an ounce. U.S. Treasury bonds are also usually prized for their relative safety, and that still seems to be the case despite the downgrade by S&P. Right now, the yield on the 10-year note is back below 2.5%, while the 2-year note is yielding less than 0.3%. The dollar is also showing some surprising strength this morning, especially against the euro. Traders are still worried that the sovereign debt crisis will spread to larger Eurozone countries such as Italy and Spain, despite an announcement by the ECB that it will actively implement its bond buying program.
Taking a closer look at the U.S. equity market, not surprisingly, banks are among the day's biggest losers. Bank of America is showing particular weakness, tumbling more than 6%. The New York Times reported that insurer American International Group is suing the biggest U.S. bank to recoup more than $10 billion in losses related to mortgage-backed securities. Shares of AIG are also sharply lower this morning, down 4.5%. And speaking of financials, 5 banks and thrifts closed their doors over the past 2 weeks, according to Weiss Ratings. They are the Bank of Whitman in Colfax, Washington, Illinois Bank of Shorewood, Virginia's Business Bank, Bank Meridian in Columbia, South Carolina, and Integra Bank in Evansville, Indiana. That brings the total number of bank closings this year to 63.
One blue chip stock that may see some action today is McDonald's. It reported 5.1% growth in global same-store sales last month. The results are down from June's 7.7% increase, but slightly better than the company's projections. McDonald's said it saw continued strength in all regions of the world, but higher commodity costs are putting pressure on profit margins. Shares of McDonald's are down more than 1% right now. But we do have one big stock winner to tell you about. Transatlantic Holdings is jumping 8% a day after receiving another buyout offer. National Indemnity, a subsidiary of Warren Buffett's investment firm Berkshire Hathaway, bid $3.2 billion for the reinsurance company. Transatlantic's board continues to recommend a stock swap merger with Allied World Assurance that it agreed to in June. That's the latest from Weiss Research. Have a great trading day.